Welcome, everyone. Thanks for joining us on this increasingly festive edition of our webinar series with Karen Sticks. I'll just wait a moment while people kind of join from the waiting room there and get logged in. Just as we do, kind of a little bit of housekeeping before we start here. The chat and Q&A tabs at the bottom of your screen are where we want to see kind of interaction happen. So using the chat at the bottom there, that's where if you'd like to introduce yourself, tell us a little bit about your business, that's a great spot for that. And the Q&A tab is the thing I'll be paying kind of more close attention to as we get going, and those are questions that I can ask Karen there. So the Q&A tab, you'll find that maybe if you're viewing it on a smaller screen, there might just be a more menu that you need to click into first there. So without further ado, I would like to start by doing our land acknowledgement before I welcome Karen, and say that Business Link acknowledges and respects that we're on traditional land, meeting grounds, territories, gathering places, and travelling routes of Treaty 4, 6, 7, 8, and 10, and the home to many First Nations, Métis, and Inuit people. In the spirit of reconciliation, we acknowledge the lands of those who have come before us, reside here now, and in the future. So yeah, I'd like to start. I just introduce myself briefly. I'm Matt Hill, Director of Operations and Client Service here at BusinessLink. I'm really working towards making sure that everyone who interacts with BusinessLink, those people who go through our programs, have a great service each time. And as part of that, we're working with partners, including Karen Sticks here. So I'd like to start by introducing Karen. Karen has over 25 years of business experience working as a general manager, chief financial officer, controller, chief accountant, auditor, and accountant for several Edmonton and Vancouver-based companies in a range of industries from transportation, steel building, manufacturing, education, oil and gas, retail sports, retail computing, and lots more. She's semi-retired but continues to operate three small businesses, Sticks and Associates, her Strawberry Farm and Friends, and Skiers with Sticks. Karen, I feel you have a great name to put into business names. It's quite a gift there. Karen, yeah, Karen's joining us for this third webinar in the series, and it's great to have you here. Over to you, Karen.
Okay, well, thanks so much for that great introduction. Again, watch your chat area because we're going to be putting in a couple of handouts for you to refer to during the presentation. We have about an hour together today, and want to make this as interactive as possible. So like Matt was saying, ask away, ask questions whenever you feel one comes up, and we're going to address what your concerns and thoughts are. Even if you have something to share with us, that would be nice too, something to help others in this seminar or this webinar. So I just want to say I am a volunteer. I don't get paid to do this. I do this for my professional development, as I'm a professional accountant, and I do this because we need to get a certain number of hours in, and I just love doing this, sharing financial literacy with others. I go into schools, I go into senior centers, into libraries, and Business Link is a favorite one as well. So anyway, let's then get started. This is going to be a PowerPoint presentation, but of course, let's make it interactive. And as some of you are aware who have joined us for the first two, this is a trilogy, and we're ending with getting money, what lenders and investors want. So let's talk about some common questions business owners ask. Why will I need additional financing and capital? What are the typical sources for financing? What are the advantages and disadvantages of them? How are lenders and investors different? Why do I need a business plan and how do I create one? What are leverage ratios and how should I use them? How do leverage ratios vary between business types? And how do lenders look at my business? So let's first talk about the 5 C's of credit. When someone wants to lend you money, they're first going to be looking at your character, your reputation as a borrower. Do you have any experience borrowing money? And have you been good enough to pay back as you said you would? Your capacity. What is your ability to repay the loan? So, are you maxed out? Do you have credit cards that are maxed out? You have other loans. You really don't have any assets. What is your ability to repay the loan in the future should your business not make a go of it? Then capital. What is your commitment to the business? Really, they're looking to see if you're going to be willing to put some skin in the game, not just sweat equity, but do you have any of your own money that you're willing to put into the business? And that'll be a ratio that they want to see you contribute, just so they can see you've got skin in the game. You're going to stick it. You're going to try really hard. Collateral, your ability to secure the loan. Well, that also relates back to capacity. Do you have a fully paid off house? Do you have a car? What do you have to put up for collateral that they can go after in case you can't pay this loan back? Then there's conditions, the terms of the loan. So the interest rate, the length of the loan, the frequency of the payments, all sorts of things like that. So all lenders and investors use something like this, the 5 C's of credit. Okay, so why the heck would you need more money? Like, you had a plan, you thought you knew you were going to be able to make it on your own. Well, sure enough, you've got a viable business going. You did start it on your own. You made a good go of it, but suddenly you find yourself short on cash. So why would that happen? One reason that would cause it is you had some rapid sales growth. So you've got to finance these sales, like produce the product to finance these sales before you actually get the revenue for the sales. So that could cause it. Another one is you're stocking up on inventory. So you've got a seasonal sort of thing going on. One of your months is very busy. You've got to buy the inventory so it's there for people to purchase. You haven't made any sales yet, but you need something for people to buy. Okay, so facilities and staff expansion. Well, in order to sell, you need to have a salesperson, and in order to stock product, you need to have a facility. So that's another thing that before you get sales, you need these things in place. And in general, a mismatch in revenue and expenses. So initially, expenses usually are higher than revenue. That's just a given. You have to spend money to make money. Now, the key here is convincing the investor that the investment will result in the profitability that will, in fact, pay back the investor. And you'll recall from previous seminars, we talked about gross margin and gross margin percentages. So you're going to want to make sure that you convince them that you're going to have enough profit from the products that you're selling that you will, in fact, be able to pay back the loan. So we could, at this point, refer to the typical sources of financing and capital handout that is in the chat area. And just if you can see it there, just spend a minute looking at it. There's 5 different typical sources on this, and I'll read them out if you're having trouble finding the handout. And I'd like you to think about them for just a minute. We'll give you, a few like a minute to think and rank them. Rank them from easiest to most difficult in terms of getting this as financing. So the first one is government programs like government grants. The second one is unsecured borrowing, including credit cards. So the credit cards. Third is family and friends. The fourth is venture capital firms. And the fifth is banks and credit unions. So just spend a minute thinking about those 5 different sources, and we'll talk about them in more detail, but think about which ones you've availed yourself of, if or that you're thinking of availing yourself of, and and how difficult or easy it is to get these things going.
And even if we want to just kind of throw in the chat there, which do people think is the very easiest? So if I am in that need for some sort of financing, where would I be best to go first? Generally speaking, of course. Family and friends is a recurring answer. Friends, family, yeah.
Which
Credit
one's
card.
the toughest? Which one do you think is the hardest to go after?
I suppose depends on who your friends and family are. VC is the hardest, James going for there.
Okay.
Yeah, hardest venture capital. Someone else has put, thanks, Stefan.
What would you go to after family and friends? What's the second easiest source of capital?
I know someone had put credit cards or unsecured. James had put unsecured as the second one. A few people are adding credit cards, credit card. Ingrid puts bank. Lena puts secured loans.
And government programs are somewhere in the middle too. Okay, that's fair. Let's go forward. Okay, let's talk about the difference between lenders and investors. So lenders lend you money at certain terms and conditions, and they're relatively hands-off, but they do require periodic reports and meetings with you. Now, investors are different because they kind of become your partner and can be very intrusive, but their experience and knowledge may in fact be useful to you. They can trigger painful provisions if performance targets are not hit. So let's talk about the character of the borrower that would be borrowing. Now let's talk about how the character gets evaluated. It's really statistical. So everyone has credit scores, both business and personal, that a lender will be looking at and availing themselves of. They'll be looking at your experience in the particular business that you're borrowing from, or your ability to run a business. So if you have previous experience, they'll be definitely looking at that. And they'll be looking at your experience in the past with borrowing money. Were you a good borrower in the past? And if you are, that really helps to add to your character. They'll be looking at your reputation in the community. Do you involve yourself in the community and try to give back and do good things? And are you a donor? Do you volunteer? That sort of thing. And they will also, the relationship you develop with who you're borrowing money from is very important. So developing a good communication strategy to keep them informed and a good relationship. So they know who you are and they're comfortable with who you are. So now measuring your capacity for a loan is based on ratios. And so it's great because it's mathematical and it really tells a story. So what they do is they look at liquidity and leverage ratios. And one is a current, another is a quick. There's a 1-year time horizon looked at, a debt to equity ratio for leverage, interest coverage ratio, fixed payment coverage ratio. We'll go into these in more detail. So you'll be doing this and identifying industry benchmarks for these ratios. This is what your lender will be doing. So let's first look at the liquidity ratios and the current ratio. So the current ratio is simply the current assets divided by the current liabilities on your balance sheet. So they're going to be looking at your business balance sheet and wondering, well, does the business have adequate liquidity? Can your assets cover your liabilities, like your cash and your prepaids? Do those cover your accounts payable? Then they'll be looking at saying a higher number will indicate that it's much less liquidity risk because, of course, your assets are way higher than your liabilities. So they're saying a ratio of less than 1 is definitely a liquidity problem. And you should talk to your lender. What do they expect you to maintain as a liquidity ratio? And here they're giving an example of a 1.5 current ratio. That seems to be a bit of a good ratio to strive to achieve. And they like to use a 1 year time horizon with quick. As we know on a balance sheet, anything in the current category is a 1 year time horizon. Now, another one is a quick ratio, current assets minus inventory divided by current liabilities. So they're trying to figure out again, does the business have adequate liquidity? And it assumes that the inventory really isn't very liquid. So that's why they want to deduct it from your current assets. They're saying, well, it's not really an easy way to get money. So let's leave that out of the equation. And again, they say a ratio of less than one is a liquidity problem. Again, ask your lender what they expect. So you know out of the chute what you've got to achieve to keep them happy. And in this instance, they're saying a 1.1 quick ratio is good as opposed to the other one because this is definitely quick. Like it'd be probably your cash and your accounts receivable divided by your liabilities. And that's, that's why they're using a slightly lower than what they did in the other example. Again, it's a 1 year time horizon. Leverage ratios, debt to equity. So you take a look and see what your total liabilities divided by your owner's equity is. So it's a measure of how leveraged or debt ridden your business is, like how much. And the capital intensive businesses tend to have higher ratios, and lenders prefer lower numbers, 2 or lower. So that's what typically is an industry standard. But again, ask your lender what they expect because this is the relationship you're trying to build is so that there are no surprises for your lender. You have a great way of communicating with them and informing them. And a really great way to communicate with them is to provide financial statements as frequently as they would like to see them. I think generally they would really love to see them quarterly. I mean, if you happen to be able to hand them to them monthly, depending, but definitely annually. And in many instances, they either need them audited or an accountant's comments where it's slightly audited but not fully audited. That type of thing if you're borrowing money. Here's another leverage ratio. How much does your operating profit cover your interest? So operating profit divided by interest payment. So it indicates whether your business is earning enough profit to cover its interest expenses. Now, a really good example here is the government, the federal government. They're heavily in debt, and their revenue is yours and my taxes, and their interest is however many millions, billions they're in debt, and they're going to have to start asking for more revenue from us to cover their interest paid, and I don't really like that. Now, interestingly enough, they're lowering interest rates, so they're lowering the interest payments because of that, and so they're kind of getting themselves out of hot water by lowering interest rates, and maybe they won't have to ask for more taxes. But I mean, that'll remain to be seen because they like to give out money too. So we'll see what happens in the next year there. Again, a ratio of 2 or higher is preferred by lenders, and ask your lender what they expect. You'll notice all these are followed up with ask your lender what they expect, and that's the way you keep on good terms with your lender. What are you looking for from me? I'd love to provide it for you. I want a good relationship here. I'm doing the best I can. As long as they feel you're trying to communicate with them, keep them informed, they'll work with you. That's the key. So fixed payment coverage is another leverage ratio. It's operating profit plus asset lease payments divided by interest plus principal plus asset lease payments. So can the profits cover the lease payments? And a ratio of 2 or better is preferred by lenders. Again, ask your lender, what would you like to see here? Here they're using a 2.6 coverage ratio. So let's talk about leverage ratios in different industries. So the more leveraged the business, the more risk it has taken on. Now, for some companies, the maximum acceptable debt to equity ratio is 2. The average debt to equity ratio is actually 1.5. And capital intensive industries often have a debt to equity ratio above 2. Now, you probably know what a capital intensive industry is, but I'll give you a good example. It's an industry where you have to buy a lot of equipment in order to produce your end result. So I can tell you, I think a manufacturing company could be extremely capital intensive. And what's really nice about an industry like that is there are barriers to entry. My family operates a steel manufacturing company, and so there are some barriers to entry, but it is a very capital intensive industry. And so, it's just a fact. That's one. And well, you can think of a few others. Maybe some of you are involved in them. A non-capital industry, on the other hand, might be someone who's, say, a software developer, because most of that is just a developing, a thinking. It's going to be intellectual capital that you invest in it mostly. Another business would be an accounting business. Mostly what your investment there is a computer. And the way we do things now is you don't even have to have office space. You can operate out of your home office. So that's helped a lot. And then you can meet people in various locations, professional locations, and instead of having to pay for a lease or a building as you progress.
Yeah, we have a question here, Karen, from James. Do you include sweat equity as liability or debt? I am a service-based business with no physical inventory.
Okay, well, lenders are definitely aware of the term sweat equity, and definitely knowing that you are personally involved in the business would definitely be an asset when they're trying to decide whether to lend you money. But I will say that lenders are looking for something tangible, and sweat equity is intangible. So when we'll talk about collateral in a minute, and you'll see what I mean there. So sweat equity is important, but it's not as as high ranking as having something that is tangible that they can take. I mean, they can take sweat equity, they can make you, well, you'll see what I mean in a minute.
Yeah, and just one of there's a few kind of questions, but one here just around credit, really. Well, two that I'll merge together. So someone asks, how far back do they assess credit and experience with institutions? And then someone else asks, kind of connected, I claimed a consumer proposal in 2021. So as a corporation now, how long do I need to wait before I can apply for a loan?
Okay, so the first question is, how far do they look back? Well,
Yeah.
your history is your history. So they look back as far as your history is. And the second question was, can you repeat that?
Yeah, it's they claimed a consumer proposal, which I think is a kind of way of managing a debt situation, maybe personally. And now, as a corporation, how long do I need to wait before they can apply for a loan?
Yes. Well, I would apply as soon as you want a loan and just see what the lender says. There's no limit on whether you can or can't apply, but there is a limit on whether they will accept you. And certainly, like we talked about the different ways of getting a loan, there isn't just one way to get a loan. So be creative, and when the one door closes, maybe another will open. I would never say you have to wait for anything.
And I think the thing that we sometimes see, Karen, is people thinking that they need everything, full business plan, everything before they even start that conversation with the bank or whoever it might be. And I would say from our experience, go and have that conversation at an early stage so you can really understand, is this a tree worth barking up? Is it worth, pursuing, or do I need to maybe change my focus somewhat? Yeah.
That's a great point. Exactly. Okay, let's talk about capital. So the lender or investor wants to know how much of your money is in the business. Okay. How well capitalized is your company? So they want to know, have you put any of your own money in the business? Do you have enough capital to withstand any, hardships that the business faces? And this is spoken about as an equity ratio, capital stock plus retained earnings divided by total assets. So have you made any money? Retained earnings is the company's made money. You've kept the money in the company, and then you're dividing it by total assets. So in some instances, what people will do is they will pay out the entire profits to the shareholders on an annual basis. So the company, they won't pay the entire amount out, but they'll pay a substantial portion out. So you want to make sure that the investor is aware of how you've done your tax planning in the past. It's very important that they understand that the company has been viable, it's made money, and we've taken it as salaries. But your income statement will show, what the owner's salaries were and that sort of thing, and you can highlight that for them so they understand that. Again, you'll be looking at industry benchmarks to evaluate, whether you've got enough capital invested, and you'll talk to your lender again. Ask them what they're looking for. Let's talk about collateral now. Collateral is the property that will be seized if the loan payments are not made as agreed. So a lien can be placed on the property to incent the borrower to make the payments. So a lien is something they place on say your house or your car or whatever. And if you don't pay, they will take your house or your car, and they will use whatever they can get by selling those items to pay off the debt that you owe them. So that's, of course, to incent the borrower to make the payments. It reduces the risk of extending credit to the borrower, and it limits any type of loan losses for the lender. Typically, the loan to value ratios are about 65%. So again, remember, they're not after your property. They just want you to pay. So they really don't want your house or your car. They just want you to pay your loan back as agreed. And they need to make the money on lending you the money. Like they want you to pay the interest and the principal back as agreed. And that's how they're evaluated in their job. So let's talk about loan conditions. Well, interest rates. We kind of talked about interest rates going up and down. Recently, we had another decrease in the Bank of Canada rate, which is going to make borrowing money less expensive. There's always various fees, like there's administrative fees involved in coming up with a loan that you'll be charged. Each loan will be for a different time length. A short-term loan could be, between 1 and 5 years. A longer-term loan is something like a mortgage, which is 25 years, or they're talking about, and they are implementing even higher length mortgages, upwards in the 30-year range. The fixed amount or a line of credit. So a line of credit is something you draw into when you just need a little bit of money to get you through collecting your accounts receivables. They may be stretched out longer than your payables are, that sort of thing, or you had to buy some special inventory and pay for it sooner than you wanted to. That's why you get a line of credit, is just to cover those incidentals, and maybe you have to pay the payroll sooner than you're getting your revenue in, those types of things. There's just timing differences between how your expenses happen and how your revenue is collected. Interest only periods. There may be a period of time on your loan where they'll say, well, just pay the interest and you can keep the principal for a period of time. That's just so you can get off the ground and get started. Um, Talking about triggers to accelerate payments and triggers to change interest rates. So these triggers are usually put in your loan conditions as incentives to make sure that you are following the agreement. And each of your lender will be different in whatever those triggers are. You can only imagine, what those are. If you miss a payment, what's going to happen? What trigger are they? What's the penalty if you miss a payment? That's what a trigger is, really. Okay. Investor conditions. Investors are not just giving you money, they're becoming your partner. So investors expect to have an equity or a stock position in your firm, more monitoring and involvement in the firm, more protections. Maybe they'll want you to have life insurance, and the ability to force payouts at special terms. Venture capitalists expect a much higher return on their investments than lenders do, and they're also willing to take on more risk. How are we doing for questions, Matt?
We do have one right here from someone who wants to expand their cafe business and make it a franchise. Just asking about how do they reach potential investors? And is it better to have a loan or investors?
Well, that depends on you. Um, Again, investors want to know more about what's going on because they don't have sort of a fixed repayment schedule usually, whereas bankers and whatnot, as long as you're paying back the loan as agreed, they'll leave you to run your business. But it depends the type of business you're in. Like I can think of a cafe, you probably have some regular customers who might want to become an investor. You just never know. That might be a really nice arrangement where they love your place so much and they just don't want to see it disappear that they would become an investor.
And for lots of the small businesses we're talking about, we are talking about people perhaps like that. These are not necessarily people on, 30th floor of skyscrapers on Bay Street, are they? They are members and part of your community, probably, that you have some existing connection with. And yeah, I would imagine. We have James ask a question for pre-seed funding, not from institutions. What is the preferable agreement? Revolving line of credit, loan with interest period, or SAFE? I don't know what that is. Are we getting maybe a little bit technical?
Well, honestly, that varies depending on what the business is all about and what you're doing. Like it sort of depends. Like some of that is more expensive to borrow. Like for me, I'd want to borrow it the cheapest way I possibly could. And
Mhm.
I'd also want to make sure I had the cash flow when I needed it. And so I can't really answer that without analyzing your business in detail. But
Yeah, it's going to be very different.
excellent question, and I'm glad you asked it because that's critical. There are so many ways to borrow money, and you need to mix and match. It's like going to the grocery store. You don't just buy one thing to eat. You buy all sorts of things to make your life pleasant. And this will help you to think. If you can't obtain your financing one way, think of how else you're going to do it. And ultimately, though, you want to make sure you don't put yourself out of business by borrowing and ending up paying so much interest that you can't, make any money. So that's very critical, and you want to analyze that as you move forward.
Thanks, Carol. Thanks.
Okay, one of the things that investors and even banks like are business plans. And I think you as a business owner would probably like that too. I mean, I love a plan that sort of lets me know whether I'm actually achieving what my goals are. And really, that's what a business plan is. So it should show that you have a really good understanding of your business. It should show that it should make clear what your assumptions are. So you'll be assuming, some risks and some competition and the probability of making certain revenues hold true. They tend to like to see a 2 to 5 year forecast so that they can see you're looking ahead and you're going to build on your plan, and it's got to seem reasonable. Like, it's really easy to put numbers down on paper, but unless you really back it up with something substantial and like, what are your actions going to be to make sure that you actually do achieve that revenue, it's going to be pretty hard to sell that business plan. So the idea here is that you're going to demonstrate that the cash flow will be adequate to make your future loan payments. So here's a detailed slide about business plan elements. I added this one because I thought it sort of would give a clearer picture. You'd want to have a table of contents and a nice salient executive summary, just with the salient facts, so that they don't have to read through the whole plan, but the key things that they'll want to know about. You'll have a company overview, so you'll describe what you're doing, and then a market analysis, so they can see that you've gone out, you're looking to see whether this is going to work, you're in the right place at the right time or the right place at the wrong time, and all that sort of thing. And you do have some sort of sales and marketing plan so that you can achieve the revenues you say you're going to achieve. They'll want to know who the management is. So who are the nuts and bolts, the guts of the company? Do they really have the skills to make this thing work? And they'll want to see your operational plan. I like using Gantt charts, and a Gantt chart can easily be constructed in Excel of a who, what, and when. Who's going to do what and when? And make sure you stick to it. And if you don't, you better have a good reason why you don't. They'll want to know what the legal structure of your company is. Are you a proprietor, a partnership, or a business, or just how's your structure? Who's got equity in it? Who's the sweat equity guy or gal, and who's the money bags person? That sort of thing. They want to know, and also who has the expertise, right? It's that's the sweat equity, and as well. So you need both. You need money invested, and you need to show that you can actually make this thing work. The last thing is financials. We kept talking about, well, ask them what they want. Well, a great way to keep your investor or your banker happy is to give them frequent and fulsome reports about what you're doing. So financials are great, but commentary to go along with the financials is even better. So do that on a fairly frequent basis, and you'll keep yourself in good stead with your investors. So from the banker and the investor's viewpoint, basically bankers and investors see you as a potentially profitable customer or partner. Like I said, these people get evaluated like it's a job for them. They're lending money, and they have to make sure that they're lending to credible borrowers so that in fact the bank gets paid back, and both on interest and principal, and so that they make money off of the loan that they lend you. They also see you as a potential way to lose money. So obviously, if you can't pay them back, then well, they wouldn't look as good as an employee, and they'd be in trouble themselves. They also see you as a risk management problem to be researched. So if you don't provide enough information for them, you make it riskier for them. And if you don't keep reporting into them, you're creating risk for them because they don't know what you're up to and what's going on. So the key is to make number 3 easy for them and show them that you're not number 1 or number 2. That brings us close to the end here. We have a few resources here that we left you with. I think we put the glossary terms in the chat area. Well, the implementation checklist will be there, and that, just to briefly describe it to you, that also brings up the typical sources of financing and capital again, and then it sort of talks about developing your opinion on how you'll address the 5 C's of credit, and then it talks about the ratios and the typical ratios that you should be aware of or get someone to help you with, that the lender or will want. And then the other part is make sure you have an updated business plan and a list of questions uh, prepared for your accountant, or if you know how to do financial statements, it doesn't hurt to develop a to-do list of things that you want to be prepared for as you're developing your financial information. There's a free ebook out there, How to Get a Business Loan through the Business Development Bank of Canada. And there's the link to it. And then there's also a video on how to get a business loan through the Business Development Bank of Canada. And there's the link there as well. So, with all of that, and having said all of that, we can at this point open the whole session up to comments and questions. So, if you've got something to share with us that would help others, or if you've got a question you're wanting to ask yet, we have a little bit of time left to do that.
This is great. Yeah, we've got some good time. So feel free, everyone. Like I say, I'll keep an eye on the Q&A section here. We've got some questions to start us off. But the bit more detail that people give, it definitely makes it easier for us to give a bit more of a fulsome answer. So a little bit of context, situation's really, really valuable too. So Linda asks, how detailed do financial projections need to be in a business plan to make a strong impression on lenders?
Well, if you can have a mix of actual and forecast, that is good. So there's a certain length of forecast out. Like we were talking about, could you forecast out as much as 5 years? Do you have some historical information, like previous 5 years, showing how you built on what you've done? So they'll want to see an income statement, a balance sheet, and a cash flow statement. They'll want your business plan. They'll want to know, some verbal information as well. So um, like we said, the business plan is it's a great way to express what you're doing and have done. And I think it's really key though to have a summary of your detail, and then if they want to, they can refer to the detail, or you give them the summary and you say more detail can be provided if you don't want to give all that out up front.
Okay, perfect. Thank you. Thanks, Linda. Shane asks the question, do investors ever try to claim they were lenders after the fact? Like, I didn't invest that money, I lent it. They expect the money repaid when the investment fails, or even vice versa.
Oh, I'm sure. Yeah, I'm sure that happens all the time. And I think your question really is, how do you deal with that? Um, well, you know, I think that's a really difficult question, and it sort of depends in each situation. But if you, as the business person and owner, or whatever you would classify yourself as in that situation, have done your best to make the business go, and you've been keeping them informed, and you've been asking for assistance from them in a logical, fair manner, that's what you can rest your laurels on, I think.
Yeah. Yeah. So having strong documentation and things as well.
And
Yeah.
communicating
Yeah.
well throughout. Like, not, there shouldn't be too many surprises. Like, if you're reporting in monthly to start with, which you might want to be doing, or quarterly, something like that, they won't have a big surprise come upon them at the end of the year, if you see what I mean. They'll
Mm.
have had 3 other or 4 other iterations before the end of the year, and they'll know what's coming, and you've sort of softened the blow, so they're not going to be, hopefully, as as upset or anxious about it, you've been able to explain why things are the way they are, and they'll either tell you as you go whether they like it or they don't. So you won't be surprised either.
It kind of puts me back to when we were speaking to lots of business owners in that kind of onset and first year of COVID, the impact there, and really where the advice that we were giving again and again was speak to people early. Like if you are not going to be able to make that repayment in a month's time or 2 months' time, like start having the conversation straight away. Where we saw people really running into more problems is where they were perhaps burying their heads in the sand or hoping that it was going to miraculously turn round. It was the strong communicators who were able to kind of, I suppose, buy themselves a little bit more time there that we saw.
I actually know of an example where a very viable company, and I'm not going to use any names on it, was, providing a first rate product to a customer. And for whatever reason, and many other customers as well, one of the big customers and one of the big accounts receivable had very suddenly went bad. So it started to erode what this company was able to do. So they had one bad apple in the pie that was spoiling the pie.
Mhm.
Well, what this business owner did is they made sure to the banking institution that they understood exactly what was creating the problem. And they worked with this business owner, and it was a whole difficult situation that they had to work through. But it wasn't really the business's fault. It was that they had gotten in with someone who didn't have the ability to pay what they owed the business. And so that's an example of where good communication can help you through a tough solution, tough situation.
Yeah, yeah, thank you. This is a perfect question for you, Karen. Scott asks, what is the best way to find a good, small, medium-sized business accountant?
I would contact CPA Alberta, and they have a list of companies, and they don't necessarily recommend one over the other, but they definitely have a list of the people that have gone through their professional training, their professional accountants. They're all listed there. They're paying their dues. They're good, upstanding, honest citizens, and that would be what I would do. So contact CPA Alberta. We have an Edmonton chapter, a Calgary chapter, that sort of thing.
Yeah, that's perfect. Yeah, that's great advice. And speak to your community as well. Hey, like if there are people that you know who are in business or who have good accountants that they like and respect, well, as long as they're properly certified and things, like it's a great starting point. Yeah, build your network. Cherie asks, I think she writes business plans for people. She says, should she be recommending that people get 5-year financial projections or 3-year financial projections? She tends to recommend 3 years, especially because it's cheaper for clients.
Well, it depends what the lender wants. If the lender wants 3 years, I'd go with 3 years because I'd rather not pay you for 5 if I could pay you for 3.
Yeah,
I'd
yeah,
ask, what does the lender want, and go from there. And I guess sometimes they're asking for you to produce the business plan before they go to a lender as well. So I would say start with the 3 year and then go from there.
perfect. And this is a question that I kind of answered by typing, but we definitely have time to have it here as well. Do we need to have different business plans tailored to different lenders? So let's say we're looking for angel investment. We want to get some investment from friends and family, maybe different financial institutions. Do I need different business plans, or can I do one and send it off?
I would start with one. And then if you can see there are certain requirements that the type of lender needs, you would could modify it from there. But I would have my one core template business plan and then just be able to modify it slightly depending on who you're dealing with.
Yeah, I feel it's a little like a job, like a resume for a job, isn't it? Like our resume doesn't change drastically, but if we're applying for something that has, I don't know, more leadership responsibilities, we might just tweak it and highlight those responsibilities. And if it's something more technical, we might spend a bit more time on that. So, yeah, one that we adapt and modify. An anonymous attendee. These were always the good questions, the anonymous ones. I've been in business for 8 years, incorporated in the last three. I'm there in the event industry and was affected, understandably, by COVID. Been bootstrapping and self-funded for all 8 years. My rental inventory asset is over 150,000 with no business debt. I'm now in growth stage and need a space and hire more hands, but my credit is poor, 500 range. What advice would you give me to help access capital? BDC rejected my application 3 years ago, and my credit has dropped even lower, and I really need the funds.
Well, I think that we've talked about the different sources of capital. You obviously are at a point now where you need to look at, and I don't know how much you need it because you're saying you really need it, but how much do you need it? So you're looking at venture capital financing, that type of thing. Like we talked about the five different typical sources, family and friends as well. You know, are there any customers that you have that you could partner with? You have to start looking creatively now because there are some people that really depend on your business. You have to be careful though when you share that, oh, I'm in financial, I need some cash to get me through and whatnot. You have to really be careful with who you share that with. So it's a tough question that you're asking, but certainly if the typical sources of capital have dried up for you, you have to start looking at alternatives. And you've heard of crowdfunding too. Some people are super successful going on the internet and just asking for money. It's shocking, but people will give you money. It's just that's you have to sort of like getting a job. It's the rule of 50. Have you actually put 50 applications in? Because if you haven't, how can you expect to have like, just a regular job? Have you really put the thought in on all the different places you could go to? And it sounds like you are doing that right now. So keep on with what you're doing and don't be afraid to explore the unusual or the unknown.
Yeah, there's a brewery in Calgary here. I'm sure they won't mind me sharing it because he told this story at a big event that I was at. It was Toolshed Brewing, and now it's a kind of large, successful craft brewery. Seemed to be very busy. But he said like he'd reached a point where there was no money, and they were their their doors had not opened yet, and his wife went to fill up with gas and she couldn't, this thing, and he went to people who were customers and basically, yeah, I think he sold them lifetime beer for $3,000, and he got, let's say, 100 of those and was able to kind of proceed like that. But yeah, needs necessitated that he did something a little creative there. Yeah, he's a good speaker. His name's Graham Sherman, if anyone wants to follow him. But yeah, Toolshed Brewing. There is, yeah.
I was also going to add, I know there was a golf course just south of Edmonton that got their funding by selling lots to potential home builders. So they said, what we'll do is if you'll buy a lot for whatever price they charge them, we'll give you a free lifetime membership in the golf course. And so they raised all their seed capital to build the golf course that way. And now it's a very, like it's a well-known golf course here. And it's quite surprising, that they had went through that difficult startup of it and managed to get some money that way.
Yeah, perfect. Thank you. Um, Dwayne has a question. It is quite long and technical. So just Dwayne, I'm going to put in perhaps for you to email me. I'll put my email is just matt@businesslink.ca because I think it's more of a connection or a bit more in depth than for this. But I'll make sure I'll type that in. James and James definitely wins award for most questions today. So thank you, James. James, we asked the question, what's the average ROI expectation, so return on investment expectation from angel investors? Do we go on annual percentage returns or total return from investment to exit, i.e. in 5 years with an exit of 3x investment? Um, maybe there'll be some people here I don't think maybe even aware what angel investors are. So do you mind just kind of talking us a little bit about that, Karen?
Well, an angel investor is kind of like what it sounds like. It's somebody who comes to your rescue and invests money in your company. And all that they're asking for is sort of a piece of the pie. So they have an expectation if they give you some money, you're going to be able to take that money, make the business profitable to a certain percentage. So their return on investment that they expect is going to be at least as much as they could get um, wherever they're investing their money currently. And so let's say if they had it in a GIC right now, they would be getting 3 point something or other percentage on it. So they would expect 3 point something or other percent. Well, if they had it in the stock market and they had it in some special fund or some special stock that was not only paying dividend, but it has a capital appreciation of a certain amount every year, they would be expecting that kind of a return. So angel investors typically have sort of higher expectations because they're risk tolerant. And generally, if you're risk tolerant, you expect higher returns. I have no idea what the answer to your question is.
Yeah, it's very much on a case by case situation. And again, it's about that communication, isn't it? If this is something we're exploring, have those conversations, go to those networking events, and connect with those people because yeah, they'll be in a best position to help you for sure. Well, as we kind of round up here at noon, it really is great to just have a couple of minutes here to thank Karen and the work that she's done in presenting these three webinars across the last few weeks here. It's really been very, very valuable to the clients and the people attending. So thank you so much for that, Karen.
Well, thank you, everyone, especially for the great questions that you've presented so that adds value to the session. I must say, I really enjoy doing these presentations, and I do them not just because I need to do them, but because I like to do them. But I also always, when I do something, I want to know how it could be improved. So we do have evaluation forms that will take you 2 or so minutes to fill in. And, if you could just please take that time because we will take a look at whatever you tell us and try to make those improvements.
Yeah, and thanks, Karen. Karen's very giving of her time here. Like she said, she is doing this as a volunteer. And for us as Business Link to be able to sustain and carry on this type of programming, which we know people find very, very valuable, and for it to remain as free, it's really important that we get that feedback to be able to provide for partners and so on as well. So thank you so much, Karen, for that reminder. That all it leaves me with is thanking everyone again, directing you to businesslink.ca/events as well for upcoming events in the new year. We've got lots variety of topics. We've got some sort of more marketing content ahead in the new year as well. So lots of kind of interest there as we look to grow and succeed in the new year. But I will leave it there, thanking Karen and thanking everyone for attending and wish you a happy holidays. Thanks, folks. Bye-bye.
Thank you. Bye
Thanks,
now.
Karen. Bye.